Hi there, and welcome to video number 6 in our series here at the Expat Teacher Network. As always, we're going to start this video with our 2 disclaimers. The first is to say that we are not certified financial advisors or planners, and we are not making individual investment advice here per se. We are simply trying to pass along information that we have learned in the hopes that it will help our fellow international educators. And the second disclaimer to make is, remind our members and our viewers that this is part of a series, and as we just said, this is number 6, and we'll be discussing things or touching on things that we've talked about in videos 1 through 5. And so if you haven't seen those videos, it could be a little confusing to you. So it really is best to watch the videos in the order in which they're intended to be seen. So having said that, what we're talking about today, we've titled our presentation today, Who Let the Dogs Out? Well, we'll explain in a little while why we gave it this silly title. But really what we're talking about today is, what if you're the sort of person that just can't help yourself? Up until now, we've been suggesting, mainly due to information that we have gleaned or taken from Andrew Hallam's 2 books, Millionaire Teacher and The Global Expatriate's Guide to Investing, that most investors really should be using index funds to build their portfolio. We spent a whole video talking about why index funds are more preferable than managed funds or actively managed mutual funds or unit trusts if you're not from North America. But today, we want to talk about, well, what if you're the sort of person that frankly is like me? Ask anybody that knows me, and 3-4 times a day, every time morning coffee break, I'm pulling out my phone and I'm checking the market to see what it's doing. What if you just can't help yourself and you need to be able to buy and sell and watch stocks because this is kind of a hobby or an obsession for you? Hobbies, obsessions, it can be a fine line between those two sometimes. Well, what we're going to do is today we're going to talk about some strategies that you can use if you really do need to play the market. If you really are the sort of person that really likes to play the market, we're going to give you some strategies that will help you do it in a more intelligent way and hopefully minimize your risk. And we're going to talk about other strategies for the market in other videos. Today, we're going to talk about one that we call Who Let the Dogs Out, or the Dogs Strategy. The first thing to say is that buying stocks, it's riskier than a portfolio of index funds. There's no question about that. Index funds cover the whole market. If you're buying individual stocks, you're basically making, Andrew Hallam calls it a bit of a leap of faith, and I think that's a good analogy. You're hoping, of course, that that company over time is going to do well. And that's why one of the things that certainly I'm guilty of breaking this rule, but I shouldn't have broken this rule, and it's definitely a good rule of thumb, is to never invest more than 10% of your portfolio into straight stocks. Keep the bulk of your portfolio in those index funds using a balance between bonds and stocks. That'll give you the long-term growth that you need to build that nest egg to retire. But taking that 10% and playing with it, who knows, you might win. Then again, you might not. I've done both. I've had trades where I've been very successful. I've had trades where I've not been very successful. And as we say, we're going to give you some strategies to help you reduce the risk. Mainly what it boils down to is this: how do you pick stocks intelligently? What sort of questions do you need to ask yourself before you say, okay, I'm going to buy 100 shares of company X, right? And that's what we're mainly going to talk about today, is that process of how do you pick intelligently and how do you minimize your risk by doing so. Well, that begs the question, how should I choose a stock? And as we said before, buying shares in a single company, it's always riskier than an index fund. There's no question about that. But some helpful questions. The first one is, do I understand this company or industry? One of the examples that Andrew Hallam gives in his book that I think is a really good example is the example of Apple. And he says he doesn't buy Apple mainly because he doesn't understand enough about the tech industry. And when he looks at a company like Apple, it's very clear that they rely heavily on innovation, right? Apple is still around because they invented the iPhone and the iPad. In 2001, people forget, Apple was nearly dead. It almost vanished from existence. And now they're still around in there, and they're really a sort of like a sexy stock. They're a very popular stock. People like to buy it. And certainly Apple has managed to very successfully market a lot of their products in spite of the fact that they're more expensive. But what if that innovation runs out? What does Apple intend to do for the next 30 years? And I'm in the same boat as Andrew Hallam. I don't see it. I can't answer those questions for myself, and therefore I would never buy Apple stock. Now, maybe it's different for you. Maybe you do have a greater insight. Maybe, in fact, you work for Apple, or you work for one of Apple's competitors, and you do have a much better understanding of the tech industry, or you're just more knowledgeable about it, and therefore that criterion itself is satisfied for you, and you don't need to shy away from Apple because of this. Well, the second question I always ask myself is, and again, I took this out of Andrew's book, is it a simple business? And the main question here is, could an idiot run this business? Now, that's a very harsh question, but it's based on the assumption that sooner or later, especially if this business is held by a particular family, once you get into the second and third generation of that family, statistically, the management skills and the money managing skills dry up. It's very often the case that families that start out very wealthy, by the third generation, that wealth has been squandered. And so I sort of bring that analogy over. I bring that knowledge over into stock buying and say, well, is this business so straightforward that, practically a trained chimpanzee could run it? Because it's quite possible somewhere in the next 35 years or 30 years or 20 years or however long I intend to hold that stock, it's quite possible this company will be run by somebody who's not very bright. And the company still needs to be able to be successful, even under those circumstances. Is it an industry where there's a lot of rapid change like Microsoft? Microsoft is a company that still has a decent share price, but even Bill Gates himself says he doesn't really understand why his price to earnings ratio is what it is, that he doesn't think that companies like Microsoft and Google should have as good a share price as a company like, say, Coca-Cola, where they actually market a product, and they market a product that's very popular. Microsoft's products are very popular today, but with the advent of smartphones, it's arguable that Windows might be on its way out, for example, because Windows doesn't necessarily work terribly well on smartphones as compared to Android, which is free. Well, that's just one example. Then the next question is, what's the price to earnings ratio? This is can be a difficult thing to calculate sometimes, although the nice thing is if you go to most financial pages, a very simple one is Yahoo Finance. Look up your company. If you know the ticker symbol or if you know the name, look up your company on Yahoo Finance, and somewhere on that page of economic data, there's all kinds of numbers, and it's written there on the page. It'll say P/E. It might even say price to earnings. And this basically means if I have two companies, one, and they both make $1 million in profit in a given year, but one costs $5 a share and the other one costs $100 a share. And the one that costs $5 a share, there's 5 million shares out there. That's how many shares that they have floated out onto the market. Well, the 5 million divided by the 5, that means their price to earnings ratio is 25. Whereas the second company, the $100 a share, they've only got 20,000 shares. So their price to earnings ratio is 2. And what that means is I want that second company. Even though the share price is way higher, I want to buy that second company because the price to earnings ratio is much, much lower. And that's actually good for me as an investor, right? And the last question I want to ask myself is, does the company have staying power? Do I imagine that this company is still going to be around in 30 years? Or is it possible that, for example, like a lot of the tech companies, some new technology will replace the product that this company is buying, and then they have no reason to exist anymore? For example, has anybody heard of Atari lately? When I was a kid in high school, we all had Atari game consoles. I don't know anybody that has one now. Maybe they do, and I'm just not aware of it because I don't play with a game console. But certainly that's a company that was very large that has essentially ceased to exist. And what you realize is with a lot of stock picking, you're actually a lot better off with so-called old economy stocks as opposed to these tech stocks because they're much less volatile. If we take the example of Coca-Cola, the one thing we can say is that in 20 years from now, Coca-Cola will almost certainly be there. And the other thing that we can say is the price for a single serving bottle of Coca-Cola in 20 years will be more than it is today. They will increase the prices of their products with inflation over time, and also because their products are popular. Whereas if we look at things that are involved in the tech field, a simple example is a laptop computer or even a desktop computer. Desktop computers today are really cheap. An even better example, a VHS recorder or a DVD player. A lot of us still have DVD players, but they're really, really cheap. And the reason they're cheap is it's simple. They're yesterday's technology. You don't need them anymore. You can simply stream online, or you can use YouTube, whatever. There's all sorts of other options such that DVDs are passé and blasé in a manner of speaking. And so, funnily enough, it's a lot of these old economy companies, quote unquote, that tend to be much more solid and a much smarter, more intelligent pick for a stock than, say, a Microsoft or a Google. Okay, well, let's move on. And let's have a look at some additional questions. Once you've sort of narrowed it down a bit, there's other questions that you do need to ask yourself. And some of these I've already touched on. One, will the price of the company's products increase over time? Yes or no. If they will, then that's a point in their favor. If they don't, then no. Does the company have a low level of debt? If the company, based on its yearly earnings, was forced to pay off all of its debt, how long would it take? A good rule of thumb is 12 months. If it would take 12 months or less, then this company has a low level of debt and is probably in pretty good shape. The lower the better. And of course, the ultimate is a company that has no debt at all, although I'm not even sure there are companies out there like that, because all companies borrow for certain things and for certain projects. Is the company business efficient? Does the company have honest managers, right? In other words, is the company well run? One of the easiest ways to indicate this is there a high percentage of insider ownership? In other words, what percent of the stock is owned by the people that work for the company, especially the high-up managers? If you have high-up managers that won't or don't buy their company's stock, then I don't know why you should. If you have a CEO of Coca-Cola who says, no way, I'm not touching Coca-Cola stock with a 10-foot pole, then neither am I. If he's the one running the company, he knows better than I do what kind of shape the company's in. And if he or she refuses to buy their own stock, then I'm not going to either. And the last thing is, it's not really a question, it's just sort of something you have to think about, is to set your price. You have to have a target entry price and a target exit price. And that simply means is you're not going to buy the stock if it costs more than this much. And if it does, then you move on and you buy something else, or you hold you just don't buy. After all, not buying saves you money in commissions. Every time you buy and sell stock, don't forget you have to pay the middleman. Whatever brokerage account you have, you're going to have to pay a fee. Sometimes the fees are less, sometimes they're more. I know most of the offshore brokerages that Andrew Hallam recommends in his books tend to have a minimum commission of somewhere around $20 to $30. I think the one that sticks in my head is TD Direct Investing, that's based in Luxembourg. That's part of the Toronto Dominion Bank Group, and they have a minimum commission of $28, and then it goes up from there if the size of the trade gets to be really quite substantial. There are discount brokerages out there. I belong to one. My account is with Consource Bank, which is actually BNP Paribas. I use the German version of it because instead of paying $28, I pay somewhere between 5 and 10 euros. So that would be somewhere, I think, between like about $8 and $12 per trade. I can pay more. If I go through that account and buy something on the New York Stock Exchange, then I will pay more. But generally speaking, for things that are within the EU, I only pay about $8 to $12 a trade. But for that, I don't have offshore capital gains tax rates. I have German capital gains tax rate, which is 25%. So there's a balancing act there. I prefer to do that because the closest offshore brokerage to me is Luxembourg. And since January 1st, they would tell the German government everything I have anyway. And so I would have to pay the 25%, plus I'd have to pay the more expensive fees. And so it's easier for me to just leave my money where it is. Anyway, that's a sort of an overview of all the questions that you need to ask yourself before you're trying to buy a stock. Let's get into the specific strategy that we're talking about today. That brings us back to our title, Who Let the Dogs Out? Well, the strategy we're talking about has a nickname. It's called the Dogs of the Dow because it was invented by an American who specifically targeted the Dow Jones Industrial Average with it. However, I personally have used this strategy here in my, quote, home country where I live in Germany. And so I guess you'd say the strategy that I use is the Dogs of the DAX because I use the DAX, that's the main stock exchange in Frankfurt, instead of the Dow. But the principle of the strategy is still the same. And it's basically a strategy that's based on dividends and dividend yields. So let's take a minute and talk about some definitions. Let's assume that you're a complete novice and you're sitting there thinking, dividend, huh? What's that? Well, a dividend is simply the profits that are made by a company that are distributed to its shareholders. And different companies and different, even some mutual funds have dividends, like some of the Vanguard funds, for example, especially if you buy them as ETFs. I have Vanguard funds as ETFs in my US brokerage account, and I get dividends. And they're paid to me in cash. They're just simply paid in cash into my account. There are also some companies out there that when they issue dividends, they will either issue stock dividends, they'll just automatically give you more shares, or in some cases you'll get companies, and I've had this happen with my own account, where they'll give you the option. Would you like the shares, sir, or would you like the cash? So that's what a dividend is. It's basically a share of the profits that the company says, here, you the shareholders, you can have a piece of the pie because you own part of the company. So a dividend yield is the dividend that's issued expressed as a percentage of the share price. And hopefully you can see the little chart there that we've done at the bottom. You calculate the dividend yield by taking the annual dividends per share, right? So in the case, for example, of me, one of the shares that I own is Deutsche Telekom, the German telephone company. Their dividend is 50 euro cents per share. And then I would divide that by the share price, which I'm not sure what it is. I think it's about 16 euros and something odd. And that gives me my dividend yield. And it's usually expressed, and if you ever look at it in charts and whatever, it's almost always expressed as a percentage, right? So that's the key, is we're dealing with a dividend yield here and that percentage. Understanding that is the key to understanding this DOGS strategy, okay? Okay, so the Dividend Dog Strategy, let's talk about how it works. First of all, it was popularized in 1991 by a guy named Michael O'Higgins. And he's an American, and what he said is, if you buy the top 10 dividend yield stocks, so remember how we calculated that dividend yield. If we go back to the Dow Jones Industrial Average, which is not every company on the stock market, it's only the big ones. It's only what are known colloquially as the blue chips, right? These are the big companies. And if you look at that list of the Dow Jones Industrial Average, in the case of where I live in Germany, it's the DAX 30. If you lived in France, for example, it would be the CAC 40, right? The CAC 40. I believe it's the FTSE 100. So different companies use a different number of stocks. But in the Dow Jones, if we just stick to the United States for our example here, if you look at dividend yield, which stocks that are on that list of blue chip companies are in the top 10? These are known or nicknamed the dogs of the Dow. Why? Well, it's simple. They're big companies, and if their dividend yield, if the percent is higher, then the theory goes that the stock must be oversold, right? Because the reason the percentage of the dividend is higher, because the dividend stays the same. Okay, let's look at it this way. If the company pays $1 per share in dividends, but the share price is $12 as opposed to $16, that means the dividend percentage is higher. And that means, according to O'Higgins, that the price of the stock is too low. The stock is oversold. In other words, in the next 12 months, the stock should go up. Hopefully you're still with us. So the strategy is this. You buy these 10 in January and you hold them for a year. And then you have a look, just like rebalancing. Now, this isn't rebalancing because rebalancing suggests that you have two elements that you're trying to bring back into some sort of specific desired alignment. Here, it's a list of 10, and it's not really rebalancing, it's adjusting. It's like, okay, 12 months later, who's on my list of 10? Is it still the same 10 as it was before? If it's not, who's gone? Right? Because I bought those 10 stocks at the beginning of January. Now that it's the beginning of the following January, which of the companies that I bought on that original list of 10 are no longer on the list? And those are the ones I sell. But in the meantime, every quarter, in some cases of some U.S. stocks, like I know American Capital Agency, for example, that's a very famous one, or a very well-known one, they pay a dividend every month. Now, for me personally, and for those of you living in the EU, the strategy still works the same way. It just functions a little differently because on the German stock exchange, at least, dividends are paid only once a year in May, usually May, June, sometimes April, right? You don't get dividends being paid every quarter, whereas in the US, this is much more normal. So the idea is that not only has the stock gone up, hopefully, and that therefore it's fallen out because its dividend is now too low a percentage of its price, and so you've made a gain, so you sell the stock, but you've also made a gain from the dividend. So even if stocks have gone down a little bit, you have to calculate that if you had a 4% dividend and the stock is only dipped by 2%, you're still ahead of the game. And so the theory is that the higher yield for a blue chip company means the stock is oversold and therefore underpriced and will rise in the next 12 months. So every 12 months you have a look. Those that are still in the dogs, you keep them. Those that are not, you sell them. That's the theory. Okay, so this is just an example real quick of, I took this on the 31st of July 2015. These are the current companies that are on the dogs list. And you can see they're all big companies, and you notice none of them is a tech company. None of them. Chevron, McDonald's, ExxonMobil, right? These are all Coca-Cola, Verizon. These are all non-tech, what many analysts would call old economy companies. And you can see that it shows the price and it shows the dividend yield. Now that small dog column over there at the right is some people, they say, well, I can't buy all 10. It's too expensive. I don't have enough to buy enough shares of each 10. So there's a way to get around that by doing the small dogs, where you buy simply the 5 cheapest of the 10 dogs of the Dow. But of course, that's riskier because now you're only putting your money into 5 different stocks as opposed to 10. So there's less diversification there, yeah? Okay, so let's talk about the variations, the different sort of variations on a theme here, and the limitations. Okay, you can use only the top 5 called the small dogs, as we mentioned. The other thing you can do is, if you can't afford or don't want to buy all of these 10 stocks yourself, it's too complicated, too many fees or whatever, in my U.S. brokerage account, at least, I have my U.S. brokerage account it's kind of through Charles Schwab. The company I actually log into is called Options Express, optionsexpress.com, but it's owned by Charles Schwab. And Charles Schwab certainly does offer online brokerage accounts, unless they've stopped doing it in the last 12 months. They certainly used to. But on my Options Express account, you can buy the dogs of the Dow or even the small dogs simply by buying a single ETF. And believe it or not, the ETF for the dogs is just DOG, and then for the small dogs is SDOG. So it's easy to remember. But you can buy these. Now, of course, this is one where you would simply buy it and hold it, because you wouldn't need to readjust every 12 months, because the readjustment would be sort of done for you automatically, in the sense that this ETF tracks the dogs of the Dow, and so somebody else is doing the readjusting every 12 months for you. Also to say that O'Higgins, he back tested this. Now, it's true that past performance is completely irrelevant, but if you're going to come out with a theory and a stock buying strategy, one of the questions you have to ask yourself is, okay, has it worked up until now? Because if it hasn't, then obviously it's not a good idea. And he back tested this to the 1920s. And it seems to be that if you do this strategy, in most years, you will actually at least match the return of the Dow, or you'll beat it. So, for example, if we take 1992 to 2011, the Dow Jones Industrial Average in that time period increased by an average of 10.8% a year. The dogs of the Dow matched that. They did exactly the same thing. The small dogs actually beat it, 12.6%. Now, does this mean that they got that return every single year? No, it doesn't. One of the things that, if you do some research, which is what we did, we'll show you our sources in a little while, we noticed that in certain years, especially in the late 90s, with the dot-com bubble and bust, that the dogs of the Dow couldn't keep up with the market, that in fact they underperformed the market in several of those years. So it doesn't work for every single year. And that's an important thing to understand. This dogs of the Dow strategy, we're not suggesting buying and selling a lot. This is not day trading, okay? This is still really just a variation on buy and hold, which is something that the Warren Buffetts and John Bogles and pretty much every financial analyst of the world will tell you is the key to building wealth. Buy the stock and hold it for 25 years. Right? When my grandmother died, I think it was 2006, my family was shocked to earn that those 10 shares that she had bought of Canadian Pacific when her mother died from the small inheritance she got had ballooned into hundreds of thousands of dollars, and they couldn't understand, where did all this money come from? And I was the one that said, well, did she ever sell her CP stock? Oh, no, she didn't. I said, well, there you go. Stock splits and dividend reinvestments, and it's 40 years later, and bingo, there you go. Okay, but anyway, the other thing to say is that this does work with other markets as well, the DAX, the FTSE. The bottom list there, that's essentially, I just wanted to include some personal examples. I don't want to give away too much personal information, but to prove that this does in fact work. Metro is a chain of grocery/department stores here in Germany. I bought that one and held it. I only held it for 12 months. And I got a nice dividend from it. And if I'm not mistaken, I got about I think it was like a 40% return in a year. Now, having said that, I have other ones like RWE and E.ON. Those are both energy companies. I've held those for 2 or 3 years now. And RWE, for example, is down over 30% over the 3 years. So that means I've lost about 10% a year. But I've also gained a dividend of about 3 or 4% each year. So my loss isn't actually 33%. It's a little bit less than that. And I just simply keep holding it because the dividend is a good dividend. E.ON is another one. I'm around break even on that one. It's been up as high as plus 10%. And I hold it for the same reason that I hold Deutsche Telekom, is that those two stocks actually have the added advantage that when they pay the dividend, they allow me to take the dividend in shares, free of commissions and free of fees. So for example, I have almost 20% more shares of Deutsche Telekom than I started out. In addition to that, in the last 3 years, I've made more than 100% gain on that one. So that one's been very successful for me. Well, after all, who else are you going to get your phone from, right? The phone company will always do well. So I just wanted to show this one here. This one is the dogs of the DAX. This is I use this from dividendchecker.de. You can see I've highlighted the column there. It says REN15. That's because the German word for yield, dividend yield, is Rendite. And so that's why it's that column. And that's simply with this particular website, you can actually sort based on the different categories. I can click on Rendite and sort it in descending order. And you can see there that there's RWE, there's E.ON. There's also some that I don't own. KNS I have owned. I don't at the moment because it slipped out, and so I sold it. Münchner Rück, that's Münchner Rück AG, that's Munich Reinsurance. I've held that one for about a year now. It's been as high as 20%. It's now bubbling around 6% because the markets have gone down a bit in the last couple of months. But that's one that I tend to hold simply because it pays a very, very good dividend. And I'm the same as the people with the small dogs. I can't afford all 10 of these, and so I tend to pick the 5 that I think are the best fit for me. For example, Deutsche Börse, Deutsche Post. Deutsche Börse falls in and out of the top 10, so I don't mess with it. Deutsche Post I haven't bought. BASF and Siemens and Allianz I haven't bought. Allianz I mainly haven't bought just because it's too expensive. When I decided to buy Münchner Rück, I didn't have enough money left. But anyways, just to let you know that you can find this information online. Another really good site is topyields.nl, because they have the top 10 dividend ones for all kinds of markets: Austria, Switzerland, the Netherlands, the FTSE, the DAX. Their information is sometimes a little bit dodgy. It's unclear to me how exactly they calculate it, because when I compare it to this site, it won't be the same, but it's still, 8 out of 10 will be the same. Right, so you won't go wrong with that. So anyway, here's our sources that we used. We used some Wikipedia sources to get some definitions, and there you see the topyields.nl and dividendchecker.de. That is the dogs of the Dow strategy, or the dogs of the DAX, as you wish. It's a dividend yield strategy, and it tends to, at least up until now, it seems to be a very solid strategy in the sense that it's nowhere near as risky, in part because you're buying shares of 10 different stocks instead of just one, in part because the fact that the dividend yield is high and these are big companies. Historically, that seems to suggest that they're A, not going to go bankrupt on you, and B, that they're due for an upswing in the next 12 months. And if they don't swing up so much, you just hold them. Remember, buying and holding is still sort of the name of the game here. And this is really just kind of a sort of a slight variation on that theme for those of us like myself that really, we need to play. We need to play with this market, but never, ever more than 10%, because then it's far too risky. And if you can, you get into shares that hopefully, like Deutsche Telekom, allow you to buy more shares and allow you to reinvest the dividends for free. That's great. And yeah, that's one of our strategies. We're going to talk more about other strategies, some of which are higher risk, some of which are lower risk in the coming videos. So that was it for video 6. Please don't forget to subscribe to our YouTube channel and come join us at expatteachernetwork.com. Just send us your name and email, and we'll put you in there so you can participate in the blogs and discussions. And we'll look forward to seeing you next time.